Hello everybody, Bob Adams here. Welcome to the third of our 4 video training programs. This one here is kind of interesting. It's going to be a little bit long and there's a lot to take in. So I invite you to obviously review this one several times. There's going to be some definitions which are important to understand. And we're also going to go over how the investment process works. So to get things started, first of all, welcome to this one. Like I said, please feel free to watch it multiple times because you're probably going to want to. So what is leverage and risk? Now I only defined these two particular items in here, although there is a lot more that we're going to go over. See, part of the game and excitement of investing in the Forex are the many options that we have. Terms like leverage, margin, balance, equity, margin call, free margin, margin level, margin call level, and stop out level are very important to know. And it can seem like you're speaking a completely foreign language, and well, to a certain extent, you're right. This is a different domain. Getting started with Forex would require to understand at least these basics. This video will attempt to get you started on that path and make your new adventure an educational and a new road to your financial freedom. So let's get started with the very basics. Leverage. Leverage is the bonus you receive from the broker. Remember, he's the guy that's holding your money to become able to trade larger amounts with having a small amount of money in your account. When the leverage is 100 to 1, it means you can trade 100 times more than the money you have in your account. Or you can trade 100 units with 1 unit of your account balance. Margin is the money that will be placed and locked in the position that you take. Essentially, you bought something, the money's being held secure for it. For example, to buy $1,000 with a leverage of 100 to 1, $10 from your account will be locked in the position. So that's 1,000 divided by 100 equals $10. You cannot use this $10 to take any other positions as long as the position is still open, which means it hasn't been sold. If you close the position, which means it was sold, the $10 margin would be restored. Balance is the total amount of the money you have in your account before taking any position. When you have an open position and its profit loss goes up and down as the market moves, your account balance is still the same as it was before taking the position. If you close the position, the profit and loss of the position will be added or deducted from your account balance, and the new account balance will be displayed. This will become very clear in the next video. You'll understand why we're sharing this. Equity. Equity is your account balance plus the floating profit loss of your open positions. For example, when you have an open position which is $500 in profit, while your account balance is $5,000, then your account equity is obviously $5,500. If you close the position, the $500 profit will be added to your account balance, so your account balance will become $5,500. If it was losing a position with a $500 loss, then while it was opened, your account equity would be $4,500. And if you close it, $500 will be deducted from your account balance. So your account balance will be $4,500. One more time, the 4 that we just covered are probably the most important of everything we're going to discuss. These will come to be understood very clearly in the next video. When you have no open positions, your account equity will be the same as your account balance. That's obvious. Free margin. Free margin is the money that's not engaged in any trade, and you can use it to take more positions. Free margin is the difference of the equity and the required margin. Remember, required margin is the money that's already been committed. For example, your position margin is $10. Let's say the equity is $1,000. Therefore, your free margin will be $990. You have $1,000. You have $10 that's committed to positions that you're purchasing. If your open positions make money, the more they go to profit, the greater equity you will have, and so you will have more free margin. That gives us the latitude to be able to trade more. Margin level. Margin level is the ratio, or the percentage, of equity to margin. For example, when the equity is 1,000 and the margin is also 1,000, Margin level will be 1,000 to 1,000, which equals 1, or in fact 100%. If the equity was 2,000, then the margin level would be 200%. Margin call level. This is important. Is the level that if your margin level goes below, you will not be able to take any new positions. Essentially what it says is you've collateralized everything and the drop in that particular open positions has fallen so far that you're not going to be allowed to trade anymore because it's obligated. Margin call level is determined by the broker. When it is set to 100%, you will not be able to take any new positions if your margin level reaches 100%. When you have losing positions, your margin level goes down and becomes close to the margin call level. When you have winning positions, your margin level goes up. So the pressure on what you've already obligated is reduced when you have a gain from another sale. Stop out level is the level at if your marginal level goes below. The system starts closing your losing positions. This is automated. Nothing we can do about it. It closes the biggest losing position first. If this happens, the margin level will go above the stop out level. No more positions will be closed. Then, if that still goes down, then if your other losing positions keep on losing and the margin level goes below the stop out level again, the system closes another losing position, which is the biggest open losing position. One more item we want to discuss, this is kind of important, is risk levels. And we'll talk about risk levels a lot now and then also in the next video. This is an option to determine your own comfort level and electing the lot sizes to be traded. You will notice when you take a look at the demo accounts, there's a substantial difference in the profitability between the three levels. This is why. They're all still trading at 100 to 1, but the lot sizes are different. We have three risk levels: light, standard, and aggressive. And we'll go over those in detail here just shortly, so hang in there. Okay. The way to win in the Forex is to leverage your account by selecting currencies or precious metals, obviously at a lower price, and then selling them at a higher price. When we do 100 to 1 leverage, which is the reason we're banking in Ireland and not in the United States, we increase your chances of larger gains by 5 times over the 20 to 1 leverage available here. This gives us a chance to achieve our goal of 65% gain per year. Remember, that never changes. That is our goal. In the US, doing exactly the same trades would get us less than 15%. While the temptation to allow greed to get in front of us all the time, there is also the realistic alternative end of losing it 5 times faster too. Now, we put some conditions in to help stop that, but you'll see those in a minute. To temper your individual options, we have created these 3 risk levels. These risk levels are still running at 101, which I told you earlier, leverage, but they're buying smaller lots. This means that the smaller lot group, light, does half the size of lot orders than the standard. The standard risk level is the most common size of lots. It could be 100 lots, it could be 50 lots, it all depends. The aggressive risk level purchases an additional 50% more than the standard. So yes, we have the greed and the fear that comes into play here. The greed obviously would love to have the aggressive and just make money like there's no tomorrow, which is essentially what it's created for. But it also has the highest risk level, which means that if it goes cattywampus and sideways, this is the one that's going to get hurt the most. Each of our Investment Club partnership members have 3 options to spread out their invested funds to. The most common approach is 50% light, 40% standard, and 10% aggressive. Now what we're finding is this particular approach will pretty much assure the 65% a year. If you want to make more, you can always change it. If you want to be really conservative and put it on light, you can. That's still going to be 30 some odd percent a year. Can't knock it. But our goal is 65. Why is understanding leverage and risk important? When you're starting a new Investment Club partnership, we encourage our members to put all their funds in the light option for the first quarter. Now, obviously, that's not what I said just the previous slide, but when we're just getting things started, it's just got a little more assuredness and obviously a lot less exposure. So because of this, it's the least risky and allows you time to see results from a live account and compare those to the demo accounts for the standard and aggressive. So you can do that anytime, it doesn't make any difference. Check on it, check on it, check on it. At the end of each quarter, you're going to have an option to decide what you want to do. After the first quarter, you have those options. You get to do one of three things. You can add more funds if you want. You can withdraw your funds if you want. And you can move funds into other risk levels. One more time, I prefer spreading it out. So once you've completed the requirements to create a new investment partner, here's what happens. Now, I'm going to go through this step by step so you get an idea and why we do it the way we do it. First of all, your collective investment funds, which are made up of cash and retirement, self-directed retirement accounts, are deposited in a bank here in the U.S. In this particular case, it's Banner Bank here in Oregon. We have an orientation meeting online for all the members. I'll contact you and say, hey, time for the meeting. This meeting reviews the requirements and accessible website pages. Your 6 links for viewing, that is 3 demo and 3 live investment accounts, are completed and ready to populate with results. The light, the standard, and the aggressive. Get used to those names. The collective funds are wired to Ireland. The directives for what funds to be deposited into the various levels are then sent in. So you're going to send those to us. And we're going to go over that step by step and how it's accomplished in the next video. Okay? How do you know your investment has started? You'll receive an email stating your accounts are live. Your links will be active for the same day. You can check them periodically to verify the activities. However, after just a few days and seeing the accounts are live, I would suggest you just relax and realize your investment is doing its thing. If you want to do a quick check on your activities, you have the ability to calculate your personal gains using the chart available on the website. I'll go over those in the next video. And you'll also have a printed quarterly report in your personal folder each quarter. I will go over that in the next video. The actual investment itself has multiple trading strategies running into one account. Each of these different strategies approaches the Forex market from a different angles. One focuses on just 4 currencies. Another one focuses on other currencies, not those 4 currencies. Another focuses on currency and precious metals. So other strategies will be added and vetted over some period of time. Now, when we look for these, we also look for how long have they been running. So we look at those. Several of these have been running 6+ years. Some of them have been running just a year or 2. So what we usually do is we end up taking that particular strategy, we put it into our own demo program, and we monitor it to make sure it's exactly the same as what they say they're doing on the other side. And then we'll go ahead and put it into practice. Some of these strategies are completely robotic with very limited activities. Others are a hybrid of automation and manual manipulation. They're being watched. This is why we have that 20% high water fee. Somebody's taking care of that. Each of the different strategies, or the traders, is monitored in separate accounts, but you'll only see the net results of their activities. You will not see the results of all the traders. This way, the trading services can reduce the risk of overexposure and dead time out for robotics. We have learned over the years that robotics are wonderful, particularly if they really have tight perimeters on them, but once in a while a VPS will need, that's a virtual process server, it's not hosted here, it's hosted in Bulgaria, needs to be rebooted. So that's just one of the things about using robots. Any changes to the overall investment are done in the standard account and reflected out to the light and aggressive accordingly. I'll show you that in just a moment. And in all of this, you're going to see 6 graphic results, 3 demo accounts, 3 live accounts. Each investment club partner has its own accounts, and those results are not shared with the others. You won't see what other groups are doing. You'll only see your group on the live account. However, all of the partnerships will see the same demo accounts. The demo accounts are not affected by money being added or withdrawn. They're only running, showing what results are. So this is how this works. It makes it a little bit easier. You have the 4 traders, which are down at the bottom, seen by the trader services only. You have these over here, which are seen by everybody, the demo accounts, and then you have yours that's seen only by you. There are 4 traders that are involved, and 4 is not the limitation. We can add as many as we want, or withdraw as many as we want. Okay, so each one of your investment protected. Okay, so backwards on that, that's how that looks. How is your investment protected in a foreign country? Now, this is a common question, guys. This is why we've carefully vetted the trader, the broker, and the bank. Remember I showed it to you earlier that we're working with those who have a long history. Regrettably, we've had experience with others in the past that either were not certified We had some banks in Nigeria, or downright crooks. We had some real experiences over in Czechoslovakia. The choices we have now are long-standing and have good reputations in the Forex world. How about the 110 leverage? 100 to 1 leverage. Yes, this is the advantage and the risk of investing outside of the Dodd-Frank limitations. The game is to make sure certain parameters are in place to avoid the stop out level from occurring. Remember, that's when the broker says, hey guys, it's gotten down too far. You don't have enough collateral to back up your investment. Therefore, we're going to close this sucker out, take what we need to cover it, and go on. We have a 20% limitation on the positions. Now, that means that any trade where the value drops our equity by 20%, a little bit up and down on that, plus or minus, this account is sold and we move on. There is no long holding. How does the IRS view this type of trading? Which is a good question. The IRS doesn't care how or where we trade, just that we report it properly. Now, these are functioning as partnerships, and they do an annual return to 1065. You will receive a K1. If you're not used to that, this is how you get the report to show what the activity was and your portion of the activity in the partnership. Those will be posted in your personal folders, which we will go over in the next video. Now, the next video will show you how to read the MFX book, graphics. That's why those other first 4 that I told you were so important, and we'll go over those again in the next video. How to calculate your percentages, how to access your personal files and folders, how to determine meeting attendances and votes. Remember, if somebody goes passive, meaning they have not attended 4 meetings, which is only a quarter for each one, so that's 4 times a year. If they have not attended and placed their attendance and their vote, they get kicked out of the system. I don't do it. I initiate it because I'm the manager, but you guys are the ones that say they're out. And the reason why we do that is because it becomes passive. If it becomes passive, then it becomes a security. If it becomes a security, then what we're doing is can't be done. It requires everybody's activity. You'll be notified of upcoming meetings and their announcements, and how to complete and send in your directives for deposit withdrawals and moving funds between the different risk levels. So that covers our 3rd video. Goes over the definitions. It shows how we do the investment. It shows you the different traders, how the risk levels work. This is the real meat and potatoes of what we're doing in the investment world. The next video, which is coming up shortly, will go over how to read the results and the reports that are there. So until next time, we'll see you later.